So the market has been trading in the same range for 2 weeks as you see here. And the question on everybody's mind is which way is it going to break? Obviously, a lot of people missed this insane rally because they bought into the hype. They kept shorting the market or they stayed in cash, not really realizing that at some point money managers have to put money to work. And it was just a matter of figuring out at what price point that was. If you guys are fans of this channel, you know exactly why I was looking at 410 on the SPY, but that's neither here nor there. So in this video, we are going to talk about why the market could absolutely continue rallying into oblivion, completely murking the shorts that are existing. So we're going to get into the fact that put call ratios are back above 1 for some instruments. We have very crucial data points coming in, like CPI is coming in next week, as well as the Fed decision. The Fed decision, in my view, is already priced in, but CPI is not priced in. So there is a very interesting consideration here with CPI that I don't think is talked about enough. CPI is projected to be at 3.1%. What if it comes in slightly lower at 2.9999999%, right? Would you put it past the people who come up with these numbers to make inflation look like it's closer to the Fed's target? And what does that mean for the market? So in this video, I'm going to talk about what could possibly make the market go insane once again and rally past all-time highs before the end of this year. It has been an absolutely insane December, a great start to the month, as good of a start as any in our trading academy. We had that long on gold, which I covered for you time and time again. I might make a separate video on it if you guys want. Leave it in the comment section. I'll break down the fundamental analysis and the technical analysis of why I got in that gold trade. Closed that for $11,000 per contract. Yes, you heard that correctly. We obviously had the Tesla cash secure puts. We had the Unity software lotto calls for 100%. And then obviously we got into bonds, as I told you I would at the beginning of last month. So TMF, TLT, AGG, etc. Those are up massively. And if you want access to all of our plays, literally every single one of these plays we sent out in the Discord. Like I said, we are going to be closing the monthly memberships once again, and it is going to be invite only. So make sure that you check out the coupon code below if there is one and take advantage of this before we close it. And make sure you follow me on Twitter as well as Instagram. Actually, a lot of these plays that you see here were from my free videos. If you take a look at this, the free video that I put out last month, 4 stocks I'm watching, I had Tesla, gold, and I had the Russell 2000, which is also tearing it up. And then I had Tesla again, Unity, the 100% play was also in there. So make sure you're following me on both platforms. But the point is, we've been calling the macro events of this market absolutely to the T. Not saying that we'll never be wrong. Obviously, that will happen. I'm just saying that in general, you know, whether we're tracking the dollar, interest rates, stocks, commodities, etc., I've been calling this rally the whole time. And now, as I said before in my last video, I think that we are in a precarious spot. I think that now when people are starting to dump money into the stocks, now is likely the time that you want to start thinking of trimming. However, as I said in this video, we're going to go over what conditions will absolutely set up the next market rally, because there definitely are some, right? The market, it's not just a given that the market is going to come up to this resistance level in July and drop. The all-time highs were in January 2022. We have now matched the July highs. We actually slightly took them out on the S&P 500 on the SPY, and we comfortably took them out on QQQ. Now, all the people that are perma bears are going to want to magically short this once again. This is an accumulation pattern. These are very hard to short successfully unless you're talking about, you know, a few days here and there. But you know, everyone's going to try to short the market, and I just think you got to let December pass, man. You got to let the Santa rally pass. Obviously, we have CPI coming out. The Fed decision, in my view, is already priced in. It's going to be a skip, but everyone's banking on something bad happening. A lot of this is you know, an attempt at confirmation bias because they've been shorting the whole time and they've been wrong. So now they're going to try to double down on the shorts. Where if you actually just went long, because the stock market is up 3 days out of 4 in general, going back to the Great Depression, you likely would have been in a much better spot. Now, I do think we are set up for a recession in 2024. But what's not talked about is the market can actually rally so high up that when we finally get a recession, it's not like we were going to be revisiting the COVID lows or the lows that we set up in October 2022. I'm not Nostradamus. It really depends on the conditions that set up the recession. It depends on the extent of the recession, but I do think a recession is coming. However, that doesn't mean that I'm going to miss out on all of these gains here. So here's what I'm looking at. Here are the conditions that could likely set up for a monster rally from here. And then I'm going to talk about the conditions that will likely set up for a recession in 2024 and why I think that's the case. If you look here, the expectations for CPI are 3.1. Last month, which was the data for October, came in at 3.2%. This is something that I don't see people talk about a lot. If you look at, there's a very great site here called Macro Micro, and where you can compare different instruments or different data points. If you look here at the correlation between CPI and crude futures, right? The price of oil, basically. When we hit that 3.2 on the CPI, crude oil, if you look down here, was at $85.77, almost $86, right? Let's take a look at what the hell crude oil is doing right now. If I look up WTI, crude oil is trading at 70, flirting with going below it. So if I know that crude oil is not the only thing in CPI, you have all these other things, but just looking at crude oil, the correlation between crude oil and CPI is actually, it's pretty correlated, right? When there's a drop in crude, you see a drop in CPI. When there's a rally in crude, there's a rally in CPI. So if CPI was 3.2 when crude was 86, now that crude is at 70, what do you think CPI has a chance of being, right? And again, I'm not saying that crude is the only thing. I'm saying this possibility has to be put out there, where people are just continuously shorting the market, expecting CPI is going to come in, above expectations. Now, whether CPI is valid or not, or whether it's real, or whether we feel it when we go to the grocery store or the gas station, that's besides the point. We all know that these numbers are cooked in their own way, right? I'm not making that argument or that point. I'm merely a trader trying to take advantage of how I think they report data, okay? So please don't think that I'm taking these numbers at face value. I just am really trying to assess how they're going to report it, okay? So if CPI's expectations is 3.1 and the Fed's goal the whole time is 2%, 2%, 2%, imagine the psychological effect that will take place if CPI comes in at 2 point, it could be 2.99999999999. The fact that there's a 2 there would rally the markets by at least 3%, in my opinion, right? You'll get a plus 3% day, in my opinion, if that happens. Please hear me out. I'm not going to say it again. I'm not saying it is going to happen, but is there a high chance? Yes, in my opinion, there's a high chance, especially if you look at housing as well, right? We look at housing prices. Housing prices have remained absolutely stagnant. This is what you typically see before a recession, which is one of the reasons I think we're going to see a recession. We'll talk about that when we talk about recession. But if we just look at the correlation between CPI and crude, there's a very heavy correlation. And there is a chance that CPI can come in below 3.1, in my opinion. In terms of the Fed is likely going to skip. Like I said, that's priced in. And as I said before, that is partly the reason for this insane rally in the markets. We are pricing in a soft landing. We are pricing in no more rate hikes. You don't believe me? Look at the 10-year. Since the Fed skipped the last meeting, the 10-year's absolutely tanked, regardless of how many times Jerome Powell came on the mic saying, there's a chance we might raise, there's a chance we might raise. Does it look like anybody believes this motherfucker? Look at this. Does anybody believe him? Would bond traders pour into bonds if they think another rate hike is coming? No, they wouldn't. They would hold off, wait for the Fed to hike rates, and then take advantage of those higher rates. They do not believe the Fed. So the Fed is not going to raise rates regardless of what Jerome Powell says. I've covered this before, looking at the history of rate hikes, showing you that the last rate hike in 2006 was June 2006, showing you that FOMC meeting after FOMC meeting from 2006 until the recession in October 2007. The whole time the Fed is saying we might raise rates again, nobody believed them, okay? And there's no reason to believe the Fed here. They are done hiking rates. However, you do have to give the Fed credit for something. The Fed is actually rolling off assets off their balance sheet. They're quietly doing this. You can see that they're not talking about this a lot, but we went basically from 9 trillion all the way down to 7.8 trillion. A long way to go, but at least they're keeping their word on this. After the banks started folding in March, I thought there was a chance that the Fed would stop this. And they did increase a little bit on their balance sheet during that time period. In March, they went from 8.3 trillion to 8.7 trillion, but then continued rolling off after the bank troubles went away, right? So you got to give them a little bit of credit for that. But the Fed is not going to raise in December, and an 81% chance they will not raise in January. And you even have now a 52% chance that they will cut in March. So I believe that cuts are coming. I don't think they'll happen as early as March unless something drastic happens. Now, what is that drastic thing that could happen? Well, there's a lot of things. Unemployment comes out this week too. We're at 3.9. That's the other thing. Let me move this out of the way so that you can see it. My bad. Unemployment, as you can see, is 3.9. If unemployment comes in at 4% or greater, that's good, right? We're in the era where bad news is good news, because it means even more so that the Fed for sure is not going to raise rates, and that a cut might even come closer than expected, right? So unemployment, if it comes in at 4% or greater, if CPI comes in better than 3.1%, I do think we'll see a rally. If CPI comes in at 2 point something percent, we'll see a plus 3% day, in my opinion, right? So if unemployment continues to tick up through 2024, if home prices finally start dropping, because they do flatten out at first, but if home prices finally start dropping, if this yield curve continues to uninvert, it's not even close to anywhere near uninverted. As I said before, it takes time for this to happen. But if the 10-year yield continues to drop, but the 2-year yield drops at a much faster pace, then you will start to see this uninvert more, and we will get closer to a recession, in my opinion. This right here is the lowest pending home sales ever on record, right? So again, this will finally, in my view, finally have an effect on home prices. Home prices are being stubborn because no one is going to get out of their 2.5% home to jump into an 8% home. But this will invariably affect home prices eventually, right? Undoubtedly so. And so we also have, you can start to see that in certain sectors that track recessions really well. Trucking is actually one of the, I believe it is the most common job among American males. There are more American male truckers than any other singular job function in the United States. But you can see here that we are finally starting to roll over on trucking layoffs. Now, it's crazy to me that you are seeing these shorts creep back up. I've reported on put call ratios before. When they were above 1, that was also another reason where we ended up buying the S&P 500 when put call ratios were above 1. They finally dropped below 1, but now on indices, so S&P 500, NASDAQ, Dow, and Russell 2000, put call ratios are back above 1. On ETFs, put call ratios are back above 1. And on SPX specifically, put call ratios are above 1.2, which is crazy. And I think that these shorts can get squeezed out like crazy if those conditions I said before come into play. And above expected unemployment rate, above 4%. I think the expectation is that it's 3.9%. To me, that number looks like it is meant to be exceeded, in my opinion. They kept it at 3.9%. So 4% or greater. And then if CPI is less than 3.1%, and more specifically, if it's 2.9 something, my God, I think the market is going to rip. Even if it's 3%, I think the market will rip, but not as much as if we get that psychological 2 point something. One other reason that inflation might come in at as expected or lower, that this is the lowest, what they call multivariate core trend of PCE inflation. This is basically just a fancy metric of how the Fed tries to calculate PCE trends. And this is the lowest that it's been since January 2021. January 2021 multivariate core trend was 2.58. We are now at 2.6. And this has actually been a good predictor of lower CPI and lower PCE. And I think, if I'm not mistaken, it has never been incorrect. That is, when it has predicted a lower inflation trend, CPI and PCE tended to come in lower as well. So now if it's at the lowest level since January 2021, plus the fact that this data point on crude oil, which I spotted earlier when I was trying to do comparisons of data sets, this was very eye-opening to me. So I would not be surprised whatsoever if inflation came in as expected or lower. Now, I'm not Nostradamus. It could very well come in higher. I'm not predicting anything. I'm just saying that is what is going to spark the next rally, in my opinion, especially with put call ratios this high. I think the market will get squeezed. Now, if inflation comes in higher than expected, right? PCE, CPI comes in higher than expected, core comes in higher than expected, then I do think that this will be the end in the short term of this little rally, and we'll get a nice correction to cover some of these gaps up, at which point I will likely be a buyer of some things. And the next event that causes the 2-year treasuries to tank, right? Whether unemployment comes in lower than expected, whether CPI comes in higher than expected, the next thing that causes the 2-year treasury to tank, I would likely enter a long-term position on this. Anyway, traders, make sure you join us below if you do not want to miss another play. Really, this stuff pays for itself. I mean, it's insane how December is going so far. I only have one losing trade in December. Granted, I don't take, a zillion trades a day. Quality over quantity for me. The goal always is to find a strategy that works for you and then stick to it and size up. That is the only way to become a really profitable trader. Taking random trades here and there, waking up and taking random trades with random sizes, losing some, winning some, that's not the way to become a profitable trader. You are just clicking buttons. You really want to find a strategy that's back tested, which our strategy is back tested. And you want to be able to stick to that with proper psychology and then size up. And that is the way to become a profitable trader. Easier said than done, especially if you're a beginner. But let me know in the comment section below if you agree with this assessment. Are you short? Are you long? Are you sitting in cash? Would love to hear from you. I personally am starting to think about more cash positions here, especially as we near the end of December. I will definitely start thinking about more cash positions, but my cost basis was really good. So I have some leeway in seeing how this data plays out before deciding whether to exit or not. Leave a thumbs up if you got anything out of this video. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.